Happy Sunday. PB back in the house for another round of FhatBear Pod. The crypto market is definitely taking it easy today. Bitcoin's just kind of hanging out right around that 82.5K mark. The total crypto market cap is sitting at 2.65 trillion, down a tiny 1%. But check this out. The 24-hour trading volume has absolutely nosedived, down a massive 49% to just 41.7 billion. Bitcoin's dominance has actually ticked up a little bit to 62.1%. Bitcoin's still the king of the castle. And finally, the fear and greed index is sitting at 27. Guess we're staying in that slightly less terrified zone. No big surprises there. For alt's performance, the top winners are Guns, Mass Network, Super Rare, and ARK. The biggest losers are Pi Network, Fun Token, Fartcoin, and Layer Zero. All right, that's the lay of the land for this sleepy Sunday. Let's dig into what else is brewing in the macro world. Wall Street's having a full-on meltdown, and the CBOE Volatility Index, aka the VIX Fear Gauge, is spiking like it's 2018, and someone just mentioned ICOs. It closed at 45.31, the highest since April 2020. Why? Well, Trump's been swinging his tariff hammer like he's trying to win a carnival game. China, not one to sit quietly, fired back with fresh tariffs on all U.S. goods, and now we got a global trade war brewing. The result? Stocks are tanking harder than a shitcoin after a rug pull. The S&P 500's down nearly 14% for the year. The Nasdaq's officially in bear market territory, and trillions of dollars have evaporated from the market faster than my port recently. Investors are freaking out, and hedge funds are dumping stocks like they're toxic NFTs from a failed project, over $40 billion worth. Meanwhile, the VIX hitting 40 is like a neon sign screaming fear. Now, we're digging into some fresh chaos from the crypto scene. Nearly 400,000 FTX creditors are staring down the barrel of losing a cool $2.5 billion because they didn't get their KYC act together. The deadline to at least start the verification process was March 3rd, but apparently, a ton of folks were too busy doom scrolling X or chasing the next meme coin to bother. Now, according to filing in the U.S. bankruptcy court, if you didn't kick off your KYC by then, your claim's getting torched. But wait, there's a lifeline. There's an extended deadline of June 1st to finish the process, and Sunil from the FTX Customer Ad Hoc Committee is out here on X saying you can still resubmit if you screwed up the first time. Just email support, get a ticket, and re-upload your docs. Sounds simple, right? Meanwhile, FTX is gearing up to start payouts on May 30th, promising 98% of verified creditors at least 118% of their original claims in cash. Next story. The SEC, that fun bunch who've been treating crypto like a piñata for years, might be rethinking how they use a Howey test to classify digital assets. For the uninitiated, the Howey test is this ancient relic from 1946 where the Supreme Court decided security is anything involving money thrown into a common pot with expectations of profit from someone else's efforts. Acting SEC Chair Mark Uyeda ordered a review of the SEC's crypto regulations, including that sacred 2019 Howey test guidance, which basically said, yeah, most of your precious coins are securities, deal with it. Some people calling it a potential game changer. Maybe even a chance for clearer rules instead of the current mess where every ICO feels like a legal roulette spin. The article says Uyeda's move comes after Trump tapped Paul Atkins, a deregulation fanboy, as the next SEC chair, set to take over once confirmed. Atkins has a history of griping about the SEC's heavy-handed crypto stance, so the tea leaves suggest we might see a lighter touch. What's more, the SEC's also rolling out a shiny new framework to clamp down on USD peg stablecoins, those little digital dollar wannabes that keep the crypto casino spinning. This all kicked off a statement from the SEC on April 4th, saying that covered stablecoins, like the ones fully backed by reserves and redeemable one-to-one for USD, aren't securities. Sounds like a win, right? Not so fast, degens. The framework's got three big pillars. First, stablecoin issuers have to register with the SEC. Second, they're mandating real-time reserve audits. No more attestations from sketchy offshore accountants. Issuers like Tether might actually have to prove they've got the cash. Third, there's a redemption guarantee. If you hold a covered stablecoin, you're supposed to get your dollar back. No questions asked. Sounds nice, until you realize the fine print probably means more fees and slower withdrawals. Classic regulatory help. Enough about the crypto news. What's popping in the DeFi sector? The stablecoin market is a massive beast at $230 billion. That is 60x growth in 6 years. But I'm over here scratching my head, wondering how many more fiat-pegged tokens we need before someone admits we all just use USDT and USDC. Enter Codex, a shiny new blockchain built just for stablecoins. They got Dragonfly Capital, Coinbase, Circle, and a bunch of other big names tossing cash their way to build a Layer 2 network on top of Optimism. The brains behind this are Haonan Lee, Victor Yaw, and Momo Ong. Haonan's an ex-Optimism dev, so he knows his way around a roll-up. Victor's family owns a Malaysian conglomerate, so he's got the cash and the connections. And Momo? She's a Princeton grad who did time at Meta before jumping into the startup game. Solid crew, I'll give them that. They're building a platform from the ground up, optimized for stablecoins. Predictable fees that don't spike when some degenerate apes into a meme coin? Check. Built-in off-ramps to cash out with exchanges and local brokers? Got that too. Next story. Aave, the granddaddy of lending protocols, is finally pulling the trigger on a token buyback program. Starting April 9th, the governance crew is set to start repurchasing $1 million worth of Aave tokens every single week. That's right, $1 million a week for at least 6 months, straight from their treasury, which is apparently flexing at an all-time high of $115 million. I mean, who needs a yacht when you've got a war chest like that, right? The plan's been cooking for a while, part of this big Aavonomics overhaul that's got the community buzzing. People are calling it a game changer. Some even say it's the most important proposal in Aave's history. The idea? Use a chunk of the protocol's revenue, rumored to be anywhere from $25 to $90 million a month, to buy back Aave tokens from the secondary market and redistribute them to stackers. Less circulating supply, more scarcity, and maybe a price pump to make those hodlers smile. Last story, DeFi TVL, the pile of cash locked up in all those fancy decentralized protocols. Started the year with some swagger, but by the end of March, it was down to $156 billion. That's a $59 billion haircut. The 27% drops got yield farmers crying into their staking wallets. What happened? Let's start with Trump. When the big man started slapping trade taxes left and right, markets got jittery, and guess what? Investors yanked their funds out, and DeFi took the hit. Then there's the Bybit hack. What a mess. The North Korean hackers waltzed off with $1.4 billion, and suddenly everyone's looking at their DeFi pools like they're a ticking time bomb. Trust in the space took a nosedive, and you can't blame folks for pulling out when security is looking like Swiss cheese. For our airdrop, we're talking about Recall Network, a project that's got AI agents and decentralization holding hands. What's Recall Network? Imagine a decentralized playground where AI agents can store, share, and swap knowledge on-chain like it's a cosmic library with no late fees. The pitch? A censorship-resistant, verifiable data hub where AI can train, collab, and maybe even make a buck while some suit in a corner office pulling the plug. They're calling it the backbone of an open, AI-powered Web3 ecosystem. They started their Recall Surge program. Not an airdrop, they say, but come on, it's got all the DNA of one. You earn fragments by jumping through hoops on Galaxy and Zeely. Here's the playbook. Hit up Galaxy, follow Recall, knock out their quests. Then swing by Zeely, sign up, do more grunt work for XP. Pop over to Boost Absent Network with a ref code to rack up more fragments. That's all I got for you this Sunday. Been a long week, so let's enjoy what's left of our weekend. PB out.